Okay, everyone. So this is kind of our last main lecture for revenue recognition. So we're going to kind of go over the main concepts with accounting for long-term contracts. I'm probably going to do one more video in addition to this one that's going to talk about if there's a loss. But we're not going to have the losses on the test or anything like that. So it's just sort of an extra lecture. If I have time, I'll add it. If not, it's not critical. So we're just going to kind of get through the main part in this lecture. And basically this will conclude everything, at least for my class, that's going to be testable. And then if I have time, I'll add the extra one if there's a loss. That'll be a very short lecture though. Okay, so for this one, let's kind of talk a little bit about long-term contracts. The book estimates or points out that nearly 1 in 8 companies are going to deal with long-term contracts of some sort. That could be construction, defense, pharmaceuticals, software. There's all kinds of different industries that involve long-term contracts. And so it's something you're likely to come across either as an accountant or finance person or manager, whatever it might be. And so you got to figure out how to deal with them. And really the issue here is with step 5. So step 5 is you record revenue when the performance obligation is complete. But of course, with a long-term contract, you may have an obligation that could take a very, very long time to complete. And so what do we do? And we talked about those 3 criteria that allow a company to recognize revenue rather than waiting to the end. They can recognize revenue as they're going along. And so these are types of industries and types of situations where they've met that criteria. And so we are allowed to recognize revenue as we go along. But if we hadn't, we didn't have the ability to recognize revenue throughout or over the life of that contract, you really have to wait till the end. If you wait to the end, it could go months or years before you recognize revenue. And that really can mislead as far as the true profitability of the company. If you have like a 5-year development contract, then you get, $10 billion in year 5, but you have 0 for years 1 through 4. And so the 1 through 4 looks very, very different than year 5. And so this method allows you to kind of recognize revenue, spread that out over the life of the contract in a way that's appropriate. And so we need to learn how to do that. All right, so here's an example. Fortnite Company agrees to build a new dormitory complex for UNC Charlotte on January 1st, 2022. Project is planned to take 4 years and will cost UNC Charlotte $72.5 million. So Fortnite Company is going to get paid $72.5 million. Fortnite Company will bill UNC Charlotte throughout the project as certain milestones are achieved or certain costs are incurred. So there is going to be billing throughout the project, which means there are going to be payments. Now on the test and in life, you'd need some sort of baseline of information. And so what I have here is a pretty typical sheet of what you might have for your different projects. Sorry, my throat's scratchy. And so, whether it's in a table like this or in a system, you need access to information. And so what I've laid out here is consistent with the way the book lays it out and pretty consistent with the way if you do like a project-based accounting, if you look in a project, it's going to track all these different items. And so each year, if you kind of think as you go through time, so at the end of year 1, this is the only information that you would have at that time. Now, obviously, I've presented it all at once, but imagine I'm going through time as 49er Company marches on. In 2022, by the end of the year, this is all that they know. They know that they incurred $12 million of construction costs throughout the year. They believe they're going to have an additional $40 million in costs over the remaining years of the project. That's an estimate. They don't know, but they estimate it's going to be 40 million. And what that means is the total cost that they believe that they will incur to complete the project is 52 million, meaning that they've built in this $22.5 million profit. And then there's additional information. So there are some milestones that they have hit. And given those milestones, they were able to bill the customer 16.6 million. And of that, UNC Charlotte has paid 15.4, meaning that probably at some point in the new year, they'll pay the remaining 1.2. And so this is kind of a typical kind of a cost sheet, the way you kind of track your projects. What are my costs? What are my estimated costs to complete? What have I billed my customer? What has my customer paid? And so that's all. Now, obviously, within this actual construction cost, they're going to have everything tracked. They're going to know what they've been paying for inventory, for labor, for whatever it might be. that's all going to be tracked separately, but it accumulates in this one account for our purposes. And of course, then they march through time, right? And so in 2023, they now have new information, right? They have the cost that they've now incurred for the current year, gives them total costs for both years, which is the 23.5 million. They still have some estimated costs before the project is complete. Notice that the total estimate changed a little bit. That does happen, it's regularly. They had new billings of 16.4 million and they had collections of 16.2 million. And then on and on we go. So 2024, new costs, new total, new estimate to complete, more billings, more collections, until at the very end, we have the total cost. And at this point, it's all actual, right? We're done with the project. And so every cost that we have is actual. They've made their billings throughout the year and they have cash collections. You could have a situation where there may be a portion you haven't billed. I'm not going to do that to you, but you could have one more year potentially. Let's say they don't send out the final billings until 2016. You could have a little bit of leftover that way. But for our purposes, we're going to have everything end in 2025. And we're even going to have all the collections occur in 2025 as well. So we're just going to kind of keep it simple. All right. What do we do next? So several accounts that are unique to construction. If you were in a different industry, there would be unique accounts in that industry as well. And this is where I talk about industry expertise being important. So there are lots of accountants who are great at accounting and they wouldn't have the first clue how to do construction accounting, or wouldn't have the first clue how to do pharmaceuticals or software or whatever. And you know, I know a little bit about a lot of these industries, but I'm not an expert. But when it comes to construction, that's the one that I'm most familiar with. And so we're going to kind of walk through it. It's also the book example, so it makes it pretty consistent, and most people can understand construction contracts. So it's a good example to walk through for long term. So one account that's new is called construction in progress. It's an account you need to know and understand. So as costs are incurred against projects, in this case, this particular project, this dormitory build, you're going to accumulate your costs. So 49er Company is just going to keep rolling costs into this account, and it's going to keep growing and growing and growing. And it's kind of like work in progress or work in process for somebody who makes inventory like cars or whatever. It's similar to that, where you're accumulating costs against a particular item, and like in an inventory system, that's inventory. But for a construction company, instead of inventory, which means something else, they're tracking it using this construction in progress account. So construction in progress is akin to inventory, but now it's capturing all the costs related to a particular project. At the same time, you're going to have these billings on construction contract account. So as you bill on this project, you're going to now be accumulating the billings. And that billings on construction contract, it's actually a contra asset. And so we know when we send out a bill, typically we're going to have receivable, because now we have an unconditional right to receive payment. And normally on the other side of that, there'd be sales revenue. And in this case, we're doing sales revenue differently. And so we need something to offset those billings. And that is what this is. So billings on construction contract is a contra asset. As things hit AR, we accumulate those billings in this account. But I want to be very, very clear. It is not an asset. The asset is the receivable. That's the asset. This is a contra asset. And essentially what you have then is you have costs growing in your CIP account, and you have billings growing in your billings on construction contract account, and they offset each other. And so when you see this, when you see it reported, usually it's a net of the two. Either the CIP is a little bit more, or the billings are a little bit more, who knows, but the two kind of marry together through the process. And so with construction contracts, that's what happens, is these two accounts accumulate over time. They don't go away until the contract is over. And so you're accumulating costs in one account, and you're accumulating billings in the other account, and they grow together until the project is over. And so we're going to kind of see this play out. And again, the key feature here is the billings is a common misperception that students think of that billings account as like, oh, that's what I'm owed. Yes and no. I mean, it is, but we're capturing the actual asset in the receivables, accounts receivable. And so the billings is just meant to offset it temporarily until I recognize revenue. And so it's a little bit complicated. I get that. It's a new account. But essentially, since we're not recognizing the revenue, we need to store that somewhere, and billings and on construction contract is where we do that. All right, so the net of these two is going to be either a contract asset if CIP is more, or a contract liability if billings are more. So interesting that you notice here, the billings on construction contract is a contra asset account. Yet, if the billings are more than the CIP, we actually report it as a current liability. All right, so, but it's a contract liability, not a payable. So I want to be very clear. We have sort of these distinct types of accounts. We have these contract assets and contract accounts because there are conditional rights. But with the unconditional portion, whether that's what you owe somebody or what somebody owes you, those are receivables and payables, and those are tracked separately. And again, we're going to kind of see all this play out in this example, but just understand these are two brand new accounts, and it's allowing us to accumulate costs and accumulate billings for these long-term contracts. All right, so let's record the actual costs. And so when we're talking about actual costs, we are talking about the very top row. And so we have, if I could draw a good arrow, well, whatever it is, what it is. I guess I'll fill it in and make it look pretty. All right, so we have these actual costs. And so for 2022, it's 12 million, then 11.5, then 14, then 16.5 million. So part of it is imagining when you're incurring these actual costs, what are the two sides of the transaction? And so what are the two sides? So throughout the year, you're incurring costs, right? So you're paying employees, suppliers are providing materials to you. I mean, all these different things just occur all the time. With any one of these costs that's related to a project, if I'm assigning the cost to a project, I'm going to throw all of that into our construction in process or construction in progress account. I think I use both synonymously. But the CIP account keeps moving, right? So it keeps growing over time. And as we have these costs, it just grows and grows and grows and grows. On the other side of that, lots of different things, right? So if it's a direct cash payment at the time of the, basically I'm making a payment to my employees, that's cash. If a supplier is billing me, that's a payable. If I'm using inventory, like I'm using drywall or whatever it might be, then that's the other side of it. So whatever assets I'm using or liabilities I'm creating, that's the other side of this account. So this CIP account grows and grows and grows. And on the other side of that, there's either a reduction to an asset or an increase to a liability. And so it can be in the form of any one of these things, but you can imagine any activity that you do, there being something on the other side of that transaction. Normally on the account title, normally the debit would be to some sort of expense, right? So you'd have supplies expense or wage expense or whatever. But with construction projects, that's not how we do it. Instead of expensing it directly, we roll it up into the CIP account. And so the CIP account is an asset. It's akin to inventory for a construction company. The reference number we're going to give it is 108. Obviously, on the other side of that transaction, cash and inventory would be, assets, payables would be a liability or whatever else. And so we don't have a post reference because it could be a lot of different things. But for 2022, basically every day or whatever, every week, whatever, whenever they're going to record this stuff, the accumulation over that 12 months would be $12 million. Right. But of course, we know this would be in 1,000 different transactions. So, right. So every single time they do something, this is the journal entry that they would have. So you could imagine a lot of journal entries for this particular item for this company. All right. Of course, we'd continue that every single year after that. So this process would just keep continuing. It just keeps growing and growing and growing. Notice we're not expensing anything right now. We are just accumulating those costs in these different accounts. And sometimes somebody might ask, well, when do we expense it? And the answer is it depends. It depends on when we recognize revenue. And so we'll kind of walk through that. So basically, whenever we start recognizing revenue, that's where we're also going to recognize these costs as expenses. So I want us to be very clear in the terminology that we're using for this portion, and really in general, you should, is saying cost and saying expense really are two different things. And so right now we're talking about costs. There aren't any expenses per se right now. These are just costs that we're incurring. And so let's try to keep that clear in our heads. Okay, so now the next thing. So now let's record the billings. right? So we had initially the cost. Now we're going to say, okay, we are going to be billing the customer. How do we record those? Again, we have this ability. And so as soon as I send the bill, that is an unconditional right, because basically there's something that prompted for me to be able to bill that customer. And so what account usually is created whenever we have an unconditional right? Well, normally you're going to have a debit to accounts receivable. And under normal circumstances, you would credit sales revenue, right? So you have a receivable, it means it creates sales revenue. But in this case, remember we said we record sales revenue independently of the receivable. And so instead of debiting the receivable and sales revenue, and then of course you'd be debiting cost of goods sold and crediting inventory if you sold something, we just have a different situation. Instead of using sales revenue or cost of goods sold or any of that, instead we just have the billings. And so we don't deal with cost of goods sold. We know with inventory and all that stuff, we've already been rolling it up into CIP, so we don't have anything to do with those. And so really it's the debit to the receivable needs to have a credit, and that credit is going to be in this offsetting account, billings on construction contract. Billings on construction contract. Again, the recognition of the revenue and the expense is independent of the way that we recognize the costs and the billings. Okay, the unconditional right to payment. So the payments and the billings and the costs are independent of the revenue and the expenses. All right, so just to be very clear, those two things are independent. So nowhere in here are we going to see any expense or any revenue. That's a different process. All right, so again, we need to recognize the unconditional right, but at the same time, understanding we haven't transferred anything really, and so we can't recognize sales revenue, we can't really recognize an expense, and so we have all these complications that we've got to deal with. And so in this case, our billings throughout the year, you can see it there in gold for every year, 16.6 in 2022, and then 16.4, 18.2, and then 21.3. And again, these billings, probably not thousands of different transactions. They might bill them, at different times. Maybe it's monthly, maybe it's when there's a milestone. However, they're going to do it. It's going to be a little bit less frequent though. And so whenever we have the billing, of course, we know we create a receivable, and hopefully you already know the other side of that transaction then is the billings on construction contract. That is the only account. There's not several different accounts. It's just that account. And so both of those are assets, of course, noting that billings is a contra asset, and it's contra to our construction and progress or construction and process account. And then, of course, in 2022, the total billings were 16.6, and then obviously the different amounts for the different years. And then finally, recording collections. Hopefully that one's not too difficult. Whenever we collect, hopefully it's fairly simple that the debit is going to be cash, and then hopefully it's also fairly simple that the credit is going to be to the accounts receivable, because we know accounts receivable was capturing the unconditional right to receive payment. As soon as the payment is received, that unconditional right has been satisfied. We need to get rid of that asset. So I'm not going to spend too much time on this one. There might be questions in class and I'll go slower, but my goal was to kind of blaze a little bit through this one. Of course, we know both the receivable, both the cash and the receivable account are assets. And of course, the amounts are different every single year. And again, the collections are going to be, sort of throughout the year as well, of course. All right. All right. So now, as far as recognizing revenue, there's really two choices. One is to wait until the end, right? So we can always wait until the performance obligation is completely satisfied. And on that date, we recognize the revenue. All right. So we're going to do that one first. That's the easy one. The only thing that we're going to note here is for construction companies, they really don't have cost of goods sold. They usually use this term called construction costs. So it's a little bit different in terms of the phrase that they use. All right, so revenue from long-term contracts, 402, it's a revenue account. The total amount that we had a right to receive was 72.5 million. So for 49er company, that's the revenue they would record. The construction costs accumulate all those costs throughout the contract, and now we're going to expense it. So we're matching our expense, which is construction costs, to the revenue, which is our revenue from long-term contracts. And notice, of course, there's a difference. That difference does get thrown into the CIP account. And all this is doing is that's really what it's doing is it's getting that CIP account and the billings, because the billings are already at 72.5 million. what it's doing is, okay, let's accumulate the last bit into our CIP so that now construction in progress reflects two things, both our costs and our profits. And so by the end of the contract, the CIP account is costs and profits. And then the offsetting account is the billings. And in this case, that's all equal. Our costs and profits, basically everything has been fully billed. Now we're good to go. Everything's been equaled out. But you're going to see that play out on the next page. But just understand the CIP account is really meant to capture two things, costs and profits. When you wait to recognize revenue at the completion, it's going to only be costs until the very end, and then it will also include profits. All right. So looking at the AT accounts, I think does help. And so in 2022, we would have recorded throughout the year in our CIP account that $12 million, and also have been recording our billings of $16.6 million. And then sort of at the end of the year, you can see the balances in the two. But what's really important is we accumulate within each account. So as our CIP continues to grow, 11.5 and then 14 million. Notice that the balance continues to grow. We don't zero it out. We don't do anything. It just grows and grows and grows. The same thing with the billings. It keeps growing and growing and growing. All right. And then the final year, again, throughout the year, we keep recording those costs and we keep recording the billings. And then at the very, very end in 2025, on December 10th, when the construction contract is done, that is when we finally recognize the revenue. And so now our CIP account includes all of these costs plus this profit. So by the end, the CIP account is costs plus profit. And then the billings is just the accumulation of whatever we've billed. And we just assume that throughout 2025, we billed them for the full amount. There could be a situation where you haven't quite billed them for everything, but I'm not going to complicate your life in this class. But you can see by the end, if you fully billed everything, your costs and your profits should equal your billings. Again, the billings could slightly lag. In this case, we're just assuming that it did not. Again, lots of questions, I'm sure, during class, but hopefully you get an idea of what we're trying to capture here. Again, this is a unique situation for the CIP account. All right, then final step, after you've recorded everything, the final step is you got to get rid of those two accounts. So once the project is over, you've done your billings, and probably you wait till you collect, would be my guess. But once you finally then collect it as well, you zero that out, at the end of the year or something like that. Okay. All right. So now instead of recognizing revenue at the very end, let's talk about recognizing revenue over time. A percentage of completion is a common method for doing this. The percentage of completion can be measured by output. For example, I talked about this before. If you're paving something, you can do it by miles, sort of the output basis, or you can do it input basis, which is like costs and things like that. It just really depends on what's makes the most sense for a particular situation. Regardless of the way you do it, the key is to apply the following formula so that you're going to recognize revenue in the current period. That's the whole goal of this. What do we recognize? We recognize this using this equation. Basically, we have this total estimate for the whole project. We're going to multiply it by some measure of the percent of completed, whether it's output or input based, some percentage. And then, especially after you get going, you need to think about, okay, well, that's the total up to date. Well, then, okay, I need to subtract anything that I've already recognized, right? So if I'm in 2024 and I calculate amount of revenue that I've earned to date, well, I may have recognized some of that revenue in 2022 and some of that revenue in 2023. And so the amount that I recognized in 2024 is just whatever's left. And so that's sort of how we do this. And we're going to use costs. And that's very common for construction contracts, is the percentage of completion is going to be based on contract costs. And so that is what we are going to do. All right, so the revenue recognized in the current period, again, that's the equation, and we're going to use it. We're going to use our costs in order to do that, right? So at any given time, we're going to know the costs that we've incurred to date, and we're also going to know the total costs that we believe it's going to be in order to complete the project. And so we can, in any given year, we can understand, well, what percent is complete based on our actual costs to date and then the total cost that we anticipate that the project will have at the end. And so for each year, for 2022, again, try to do this one on your own. Remember, the total estimated revenue is 72.5 million. At any given time, you can calculate the percent that we completed. So start with 2022. The amount of cost to date is 12 million, and that amount is right here, 12 million. Those are the costs to date. And the total estimate for the entire project is 52 million. So you can get a percent complete by taking 12 million and dividing it by 52 million. And then we apply that to the 72.5 million of total revenue. And so in this case, 72.5, the ratio of the percent complete is 12 million over 52 million. It's the first year, so we don't have anything from a prior period to adjust for. And so the revenue for 2022 would be $16,730,769. Similarly, for 2023, now, of course, it's the same 72.5 million. That hasn't changed. But notice, though, of course, now our total costs are 23.5 million, and our total estimated cost is 51.5 million. So notice that the percentage ratio, of course, it should change, and it did. And also in this case, we had recognized some revenue in the previous year. So we need to subtract that out, because when I make this calculation right here, that's really 2 years of revenue together. And so if I'm trying to recognize only 2023, I need to subtract out whatever I had recorded in 2022. Okay. And so now whatever's left in 2023 is 16,351,755. 2024, similar. Of course, now it's the total cost of 37.5 million, total estimated cost, 54.5 million, subtract both years, right? So there's 2 years of revenue at this point. And so that's for 23 and 22. I'm not great with this, sorry. So I'm subtracting out both prior years because this is 3 years of revenue. So I have 3 years of revenue. I need to subtract out the prior 2 years, and that leaves me what I need to recognize in 2024. So then for the journal entries, 2025, sorry, skipped over that really fast. Of course, it's 100% by then because the project is complete. So the total revenue is 72.5 million. We subtract the prior 3 years of revenue, 2022 through 2024, which means for 2025, we need to recognize the remaining amount of 22,614,679. Again, hopefully the math by the time you get to this one, you get it, and you can review this a bunch of different times if you need to. All right, so now the journal entries. So whether we do something at the end or over time, we're really using the same 3 accounts. So remember, we have the revenue, and then we have the construction cost, which is like the equivalent to cost of goods sold. And then any difference between the two is CIP, because remember, CIP captures costs plus profits. And then if we wait till the end to recognize, we know the CIP account, again, is only cost. But if we're going to recognize revenue over time, it's going to capture costs plus profits. And so the revenue account, again, for 2022, we calculated that to be 16,730,769. And whenever we recognize that, then we also simultaneously recognize the cost to date. And now we're going to recognize those costs as an expense. And so that construction cost account, again, just as a reminder, it's a 500 series. It is an expense. The cost to date were 12 million, right? We had calculated that. We knew their cost to date. We're recognizing all those costs as an expense because that's the basis of our revenue. So we're matching the cost to date as an expense to the revenue that we recognize. And then the difference is the profit for the year, and that gets thrown into our CIP account. So again, we accumulate in the CIP account costs plus profits. And so our profits in 2022 was 4.7 million. Do the same thing in 2023. Again, we calculated the revenue. We know the costs from our sheet, and the difference goes into CIP. So by the end of 2023, it has all costs for 2 years and all profits for 2 years. It still accumulates in that account. 2024, then finally 2025, noting that that final entry is at the project conclusion, not at the fiscal year end. All right, so now let's look at the T accounts to see how things accumulate in our two accounts. Well, first of all, our billings doesn't change. So whether we recognize revenue over time or at completion, it doesn't change our billings. And so that all is the same. But our CIP account does. So remember, our CIP account used to only capture costs. So when we did revenue recognition at completion, these were the only entries until the very, very end. But now it's fundamentally different, because now, as we're going over time, now we're recognizing profits in that account as well. And so in 2022, we recognized that profit from that final journal entry. And so now the balance reflects both costs and profits. And then the same thing in 2023, 2024, noting in 2025, the last journal entry is on the 10th. But other than that, you can see by the end of each year, that account balance has costs and profits up to date. And so it really does change the CIP account when you recognize revenue over time. And by the end, you will still land at the same place. So whether you're using revenue recognition at completion or throughout the contract, by the end of the contract, the billings and the CIP account both will reflect all costs and profits to that date. All right, so let's talk about what's going to be reported on the balance sheet. So from 2022 to 2024, let's talk about what the balance sheet is going to look like. So under the completed contract method, again, remember, we report the net. And so if the billings are more, then we report the net as a current liability. If the construction in progress is more, then the net is reported as a current asset. And so when we look at the billings, if we just let's just take 2022, because that's easy to see, we can see that under the completed contract method, at that point in time, the billings were more than the costs, right? We know that to be true. So that would be a current liability. But under the percentage of completion method, now all of a sudden, look, it goes the other way, because now our CIP account includes both the cost, but also profits. And so now look, so now we have a current asset under the completed contract, or sorry, the percentage of completion method. So depending on the method, in one situation, we're going to be reporting a current liability. In the other situation, we're going to be reporting a current asset. And so that table is really where we're showing that. And so you can see that with those billings being in excess, when we're using a completed contract method, it's almost always going to be the case that you're going to report a current liability. The billings are almost always going to outpace the costs. But anyway, all that to say, you can see that this current liability is growing and growing and growing. But when we use the percentage of completion method, it's a little bit different, because really the billings and your profits, they're not exactly the same, but they tend to stay a little more on pace. It's just sort of the nature of the beast. Sometimes you can get a little ahead on one versus the other. And in practice, it bounces a little bit. But you can see initially our costs and profits were more in the first 2 years. And then in 2024, it kind of flipped. Our billings, maybe there was a big item where we could bill a lot because we hit some major milestone. I don't know, something happened where all of a sudden now our billings outpaced our costs and profits. And so in that case, it kind of flipped temporarily. But all of that to say, it tends to be closer to zero when you're using the percentage of completion method. All right, so we are not going to talk about periodic losses in this lecture. I may record it. I don't know. I haven't really decided yet. The semester feels like it's crunching on me pretty quickly. But anyways, this is what you need to know. Up to this point, this is what you need to know for the test. And hopefully, again, you can go back over this and it'll be helpful. But that's all I have for now. But in class this week, we will, I'm sure, talk about this at length on Thursday. All right, have a good one. Let's see. All right, take care.